Gold up 73%. Silver up 141%. If you see those numbers and feel excitement, you're already late. Because markets don't move like this to reward the crowd. They move like this to signal stress. And the real danger isn't missing the rally, it's misunderstanding why it happened. Most people think 2025 was about metals going up. That's surface level thinking. What actually happened is that capital quietly started repositioning away from fragility, away from promises, away from trust-based systems that depend on policy credibility holding together. If you want a clean plan instead of emotional reactions, watch this to the end. And if macro, metals, and crypto are your battlefield, subscribe to Underworld Capital. Now ask yourself this: was 2025 protection, or was it the warning shot? The 2025 performance of gold and silver wasn't impressive because it was high. It was impressive because of when it happened and what it outperformed. Gold delivered a 73% gain in a year where many investors were already convinced inflation was under control. Silver went even further, climbing 140%, behaving less like a precious metal and more like leveraged exposure to systemic stress. When you place these returns next to traditional risk assets, the context sharpens. Equities were volatile, selective, and heavily dependent on narratives around earnings growth and rate cuts. Crypto remained reflexive, driven by liquidity cycles and speculation rather than balance sheet protection. Meanwhile, metals moved with purpose. They didn't chase optimism, they absorbed fear. That's why calling 2025 a historic year isn't about hype. It's about signal strength. Markets rarely shout. They whisper through relative performance. And in 2025, the whisper was clear. Capital was seeking insulation, not upside. This matters because defensive assets don't outperform during periods of confidence. They outperform when trust begins to thin. When investors quietly question whether inflation is really beaten, whether debt levels are sustainable, and whether monetary credibility still commands obedience. So this wasn't a story about prices going up. It was a story about risk being repriced. And when the market reprices risk, it's not looking backward. It's positioning for what comes next. What kind of environment forces capital to choose defense over growth? The first force behind the 2025 metal surge was negative real interest rates. Even as nominal rates appeared restrictive, inflation-adjusted returns on cash remained unattractive. Holding money became a silent loss. In that environment, gold stopped looking like a non-yielding asset and started looking like preservation. The opportunity cost disappeared and capital noticed. The second force was a weakening US dollar. Because gold is priced globally in dollars, any softness in the currency mechanically increases its appeal to non-US buyers. But beyond mechanics, dollar weakness signals something deeper: strain in fiscal discipline and monetary confidence. When the reserve currency shows cracks, gold doesn't need marketing. Demand arrives organically. Third, central banks continued buying gold aggressively, not trading it, not flipping it, accumulating it. That distinction matters. Central banks don't chase momentum. They hedge regimes. Their purchases created a long-term structural floor under prices, independent of retail sentiment. The fourth driver was geopolitical instability. Conflicts didn't resolve, they layered. Trade routes, energy security, and alliances all became more fragile. In that environment, capital does what it has always done throughout history. It runs toward assets that don't depend on counterparties keeping promises. Finally, silver added its own unique fuel. Unlike gold, silver sits at the intersection of money and industry. Demand from solar energy, electric vehicles, AI infrastructure, and electrification surged at the same time supply remained constrained. That combination turned silver into both a hedge and a bottleneck resource. While the rails debate plays out, another infrastructure story is moving behind the scenes. Let me introduce Unic, the platform that's changing the game in crypto trading. Unic's OTC exchange has already processed over 1.3 billion in OTC trading volume, giving both buyers and sellers the flexibility they need. With over 5.5 million active users and 500K plus followers on X, it's a platform built for scale. Please note that this is not financial advice. Gold doesn't rise like this without consequences. Its movement is a mirror, and in 2025, the reflection was uncomfortable. Inflation, despite cooling headlines, proved stubborn. The cost of living didn't collapse. Expectations stayed elevated. Once inflation psychology embeds itself, it doesn't leave quietly. At the same time, public debt continued expanding. Governments didn't regain fiscal discipline, they deferred it. Markets understand this. When debt grows faster than productivity, repayment becomes a political problem, not an accounting one. Investors respond by seeking assets that don't rely on policy promises being honored indefinitely. Currency weakness followed naturally. A softer dollar doesn't just affect forex charts. It raises the price of imported goods, particularly energy and commodities. For countries dependent on imports, this translates directly into higher domestic inflation, even if local demand slows. But the deepest signal was psychological. Confidence in fiat systems didn't collapse, but it eroded. Slowly. Quietly. Enough for institutions and individuals to start diversifying away from pure trust-based money into assets with physical or historical backing. This is how regime shifts begin, not with panic, but with precaution. Gold doesn't predict disaster, it prices uncertainty. And when uncertainty persists long enough, capital stops asking how much return it can earn and starts asking how much damage it can avoid. So the rise of gold wasn't optimism, it was preparation. Preparation for what exactly? China's approach to de-dollarization is often misunderstood because people expect drama. But real financial strategy doesn't announce itself loudly. It moves incrementally through balance sheets, trade agreements, and infrastructure. The objective is straightforward. Reduce reliance on a US-centric financial system that China does not control. This isn't ideological, it's pragmatic. Dependence creates vulnerability, especially in a world where sanctions, payment access, and settlement systems are increasingly politicized. To execute this, China has consistently accumulated gold, diversified its foreign reserves, expanded bilateral trade settled in local currencies, and invested in alternative payment and settlement mechanisms. None of these moves are short-term trades. They are slow, deliberate steps toward financial autonomy. For markets, the implication is critical. This behavior creates structural demand for gold. Not demand driven by fear spikes or cycles, but demand embedded in national policy. Structural demand doesn't disappear when sentiment cools. It persists through drawdowns and consolidations. This matters because gold prices are often analyzed as cyclical assets. But when large economies treat gold as strategic reserve insurance rather than a speculative vehicle, the entire pricing framework changes. It also reframes the role of the dollar. De-dollarization doesn't mean the dollar vanishes. It means it becomes less singular. And in a multipolar currency world, neutral reserves gain importance. Gold thrives not when systems collapse, but when power decentralizes. The real question is, are markets fully pricing that shift yet? Whenever prices move violently, manipulation narratives emerge. They're comforting because they suggest chaos is artificial, but markets usually behave exactly as designed, brutally and efficiently. There are two layers operating simultaneously. The first is short-term. This is where leverage, derivatives, and momentum dominate. Futures markets amplify moves. Options force hedging. Retail chases confirmation. Volatility expands. Prices overshoot. Weak hands get flushed. This layer feels like manipulation, but it's mostly reflexivity. The second layer is long-term, and it's far less emotional. Here, prices are guided by real interest rates, currency trends, central bank flows, and industrial demand. This layer doesn't care about headlines or social media sentiment. It adjusts slowly, relentlessly, and without apology. Confusing these two layers is how retail investors get destroyed. They mistake short-term volatility for long-term direction and overcommit to a single narrative. Then, when the market breathes, they panic. Survival requires a different mindset. Not prediction, but preparation. not conviction, but conditional thinking. You don't all in on a story. You build scenarios. If conditions improve, you scale. If conditions deteriorate, you defend. If nothing happens, you wait. Big funds aren't villains. They're disciplined. And discipline, not information, is what separates winners from liquidity providers. So the real danger isn't manipulation, it's emotional exposure without a plan. Quick update on Unic. Their IDO for the UN token is live. The project markets a low FDV approach, referral rewards, and NFT perks for early participants. They present themselves as an on-chain OTC liquidity layer, aiming to capture pre-market and institutional flows. Again, not financial advice. Check the link in the description for Unic's token page and white paper before deciding. If 2025 was the year of signals, then 2026 will be the year of discipline. Those who build strategy will compound quietly. Those who chase narratives will exit loudly. Comment below whether you're leaning toward gold or silver, and why. Subscribe to Underworld Capital for the next breakdown on 2026 scenarios, DCA zones, and risk management. And share this with anyone worried about inflation but unsure how to position.